Insurance and credit cards are two essential pillars of the modern financial system that provide individuals and businesses with safety, convenience, and financial flexibility. Both are instruments designed to manage risk and enable smooth financial transactions, but they work in entirely different ways. Insurance primarily functions as a risk management tool protecting against potential financial losses caused by unexpected events, while credit cards serve as a borrowing and payment tool, allowing users to access short-term credit to make purchases and manage their cash flow. Together, these two concepts represent some of the most influential financial innovations that have shaped modern consumer behavior, corporate finance, and global economic stability. The miniature building labeled insurance symbolizes the stability and protection that insurance provides to individuals and businesses against financial risks such as accidents, health emergencies, and property losses. Surrounding it, the credit cards and dollar bills depict the flow of money and the ease of transactions in today's cashless economy. Insurance is a financial arrangement where an individual or organization, the insured, pays a certain amount known as a premium to an insurance company, the insurer, in exchange for protection against specific risks. In simple terms, it acts as a safety net. If a covered event such as an accident, illness, theft, or natural disaster occurs, the insurance company compensates the policyholder for their financial losses according to the terms of the contract. This system spreads risk across a large pool of people, ensuring that no single person bears the full cost of an unfortunate event. Insurance can be broadly classified into two main categories: life insurance and non-life. General insurance. Life insurance provides financial support to the insured's family or dependents in the event of their death. Risk, life insurance, and non-life insurance. Risk insurance protects families against unexpected life events, providing financial help during illness, accident, or death. Non-life insurance covers valuable assets like homes, vehicles, and businesses, shielding people from losses caused by damage or disasters. Both types work together to create peace of mind and stability. By paying small premiums regularly, we safeguard ourselves from big future losses. It's a way of ensuring that loved ones are financially secure even after the breadwinner's death. Examples include term life insurance, coverage for a fixed period, and whole life insurance, coverage for an entire lifetime with a savings component. General insurance covers everything other than life, such as property, health, vehicles, and business risks. For instance, health insurance covers medical expenses, motor insurance protects vehicles against damage or theft, home insurance safeguards property from fire or natural disasters, and travel insurance compensates for trip cancellations or lost luggage. Beyond these traditional forms, there are specialized types like marine insurance, covering ships and cargo, crop insurance, for farmers, and liability insurance, for businesses and professionals. Each type of insurance serves a unique purpose, providing peace of mind by reducing uncertainty in daily life. The main types include term life insurance, which offers coverage for a specific period to secure loved ones after death, and whole life insurance, which combines life coverage with investment benefits. Property insurance protects homes and assets from natural disasters or damage, while health insurance covers medical expenses. Travel insurance ensures safety during trips by covering accidents and losses. Home and specialized insurance provide additional protection for specific needs like theft, vehicles, and equipment. Credit cards, on the other hand, are financial tools that allow users to borrow money from a bank or financial institution to make purchases, pay bills, or withdraw cash. Unlike debit cards, which draw funds directly from a bank account, a credit card provides a line of credit, meaning the user spends the bank's money and repays it later, usually by the end of a billing cycle. If the user fails to pay the full amount, interest is charged on the remaining balance. There are various types of credit cards, each designed for different needs. Standard credit cards, basic cards that allow purchases up to a credit limit and require repayment monthly. Rewards cards offer benefits such as cashback, travel miles, or reward points on spending. Business credit cards, designed for entrepreneurs to manage business expenses. Secured credit cards require a cash deposit as security. Ideal for people with no credit history. Credit and debit cards have transformed how people manage money, replacing the need for cash and enabling secure, convenient, and quick transactions both online and in-store. They are essential tools for building credit history, managing expenses, and participating in the global economy. As technology advances, contactless and virtual cards continue to make financial transactions faster and safer, highlighting the growing trend toward a cashless society. Offer high credit limits, luxury perks, airport lounge access, and concierge services. For example, if a user named David buys a $500 smartphone using his credit card, he doesn't have to pay immediately. The bank covers the cost, and David will pay it back later either in full or in installments. If he pays within the grace period, no interest is charged. However, if he delays payment, interest accumulates, and his credit score may drop. This flexibility helps users manage cash flow, build credit history, and access emergency funds, but it requires responsible use to avoid debt traps. Interestingly, credit cards and insurance often intersect. Many premium credit cards automatically include insurance benefits such as travel insurance, purchase protection, and extended warranties. For example, if you buy an expensive gadget with a credit card and it's damaged or stolen within a short period, the card's purchase protection policy may reimburse you. The benefits of using credit cards in a modern financial lifestyle. It highlights key advantages such as high credit limits, luxury perks, airport lounge access, and flexibility in managing expenses. Credit cards offer users the convenience of making purchases, earning rewards, and improving their credit score when used responsibly. They also provide financial security, emergency assistance, and opportunities for exclusive discounts and cashback offers. Overall, credit cards are valuable financial tools that combine spending power with convenience and rewards for the user. Both insurance and credit cards play crucial roles in modern economies. Insurance builds stability by protecting assets and lives. It encourages investment and entrepreneurship. Credit cards, meanwhile, boost consumer spending and provide liquidity, enabling smoother cash flow in daily life and businesses. However, both require understanding and discipline. Misusing credit cards can lead to high-interest debt, while ignoring insurance can expose one to devastating financial losses. The evolution and modern role of insurance and credit cards. Historical evolution of insurance. The concept of insurance is ancient, rooted in humanity's timeless need for security. The earliest forms of insurance can be traced back to Babylon around 1750 BC, where the Code of Hammurabi introduced basic principles of risk sharing. Merchants who shipped goods would pay an additional sum to lenders. In return, their loans were cancelled if the shipment was lost at sea. This early marine insurance laid the foundation for modern risk management, the journey of financial innovation from ancient trade to the modern economy. Historically, merchants sought ways to protect their goods during sea voyages, an early form of insurance that reduced financial risk. Over time, this evolved into structured financial systems that safeguard assets and investments. The image blends this ancient setting with credit cards, representing today's tools for financial flexibility and global commerce. Together, they illustrate how human ingenuity transformed the management of risk and credit from barter and trade to the digital age. Both insurance and credit cards play vital roles across countries, but their usage patterns differ depending on the economy. In the United States, nearly 80% of adults own at least one credit card, and insurance coverage is extensive from auto and health to life and property. American consumers rely heavily on credit cards for building credit scores and earning rewards. In European countries, regulations emphasize consumer protection and financial responsibility. Countries like Germany and France focus more on debit transactions, while credit card usage is growing with e-commerce. Insurance markets are mature, often backed by government programs for health and pensions, in developing nations such as India and Pakistan. The credit card and insurance industries are rapidly expanding due to digitalization and financial inclusion initiatives. Mobile banking apps and microinsurance programs are helping millions gain access to financial protection and short-term credit. For example, Pakistan's State Life Insurance Corporation and banks offering microcredit cards are empowering low-income families and small business owners to build financial stability. Credit cards patterns and insurance appears to illustrate global trends and comparisons in credit card usage and insurance systems across various countries such as the United States, Germany, France, India, and Pakistan. The visual uses a world map and symbolic icons to highlight regional financial habits, showing how credit and insurance are interconnected in different economies. While much of the placeholder text is nonsensical, the design suggests an educational or analytical presentation about international financial behaviors, emphasizing economic diversity and modern payment systems around the world.